Here's the thing, the stock market will crash. It always does. But what really matters is what you do next. After 20 years of advising clients, I've seen bubbles, I've seen them burst, and I've seen the same mistakes over and over, particularly by those who don't feel they can afford to lose money because they're close to retiring or already retired. What I'm going to tell you today will help you realise that the biggest mistake people make is believing they need to move their money. Because to do that successfully, they don't just need to be right about one thing. They need to be right about 6 different things, all of which will just be guesses. There's a better way though. So let me show you how to prepare yourself properly and sidestep the panic. Welcome back to the channel, folks, and if you're here for the first time, welcome along. So are we heading for another tech bubble? That seems to be the question on everyone's minds, as artificial intelligence is reshaping everything from our jobs to the stock market. And we can definitely draw some parallels to around 30 years ago, when the internet started to become part of our everyday lives. Back then, just like now, people started to see the massive potential this technology had to change the world. And they weren't wrong. It did. Just as I believe AI will transform society beyond recognition, for better or for worse. But what happened then was stock markets were worked up into a frenzy by people investing into these new internet companies, giving birth to what we now refer to as the dot-com bubble. Now, many of you watching will remember this, but for those who don't, the price of stocks in the late 90s started to reach extremely high levels. But investors didn't take much notice and continued to pile in with more money, until on the 10th of March 2000, the market finally reached its peak.
Points drop never before seen on the US markets.
People had been partying like it was still 1999, and they thought the music was never going to stop. But then it did.
Very, very difficult to put the brakes on. And by 1 o'clock, everyone threw in the towel and said it's a foregone conclusion. These things are going down.
Over the next 2.5 years, the Nasdaq Composite Index, which tracks the heavily tech-focused Nasdaq Stock Exchange, fell 78% in value, giving up all the gains it had made in the previous 3 years. So is history about to repeat itself? Well, there are definitely some similarities. The valuations being placed on companies in parts of the tech sector are very high by any historic measure. We've also seen a couple of years of abnormally strong returns, but I do think there is one big difference this time. The companies whose stock prices have risen to these extreme levels are primarily already very large, established and profitable companies. Many of the companies which on paper were worth billions of dollars in the late 90s had barely made a single dollar in profit. Some of them were little more than an idea and a website. And naturally, when the market went into freefall, those companies were exposed and eventually wiped out. At the forefront of AI development, you've got the likes of Meta, Nvidia, Alphabet, which is Google, and Microsoft. And they aren't going anywhere. They're massive businesses with diversified income streams. In the 90s, it was like the new dot-com companies were houses made of straw, whereas today, the AI leaders are made of bricks. But that doesn't mean they can't lose a few roof tiles in a storm. They're clearly burning through cash quickly because they're now borrowing money from investors. Just last month, Alphabet issued $25 billion worth of corporate bonds to fund its AI investment and data center expansion project. And this is part of a wider trend, with Meta, Amazon, and Oracle all going to market to raise similar amounts between September and November. Whereas they probably all had enough cash to self-fund these projects previously, the race to be at the forefront of the revolution is obviously an expensive business. Interestingly, one of the partners in my company, Jamie, was invited along to the Nasdaq conference in London last week. He's an ex-fund manager, so he still has strong connections in the business world. And it means that we get first-hand access to the executive teams of these major global companies, which hardly any other financial advisors do. He said that a number of the companies were extremely bullish. The likes of Seagate and Western Digital, who provide storage capabilities, an essential requirement for AI, have huge demand, to the extent that their supply is sold out for 2026. Highly unusual. So there are risks, but there is evidence that support for prices is still strong. At some point, investors will decide that valuations are just too high which is when they'll start to sell out and share prices will fall. Fundamentally, the companies themselves are probably stable enough, but it would be like knocking some froth off the top of a pint glass. So are we in a bubble? It's difficult to say, but even if we are, bubbles can last for a very long time. And while they're going on, lots of money can be made. There's a scene in one of my favourite films, The Big Short, which always reminds me of this.
Watch, it will pay. I may have been early, but I'm not wrong.
It's the same thing. It's the same thing, Mike.
Sometimes being early is the same as being wrong. While you're sitting on the sidelines, you can be losing just as much money by missing out on growth as when markets ultimately crash. So during times like these, I start to see an uptick in the same questions from clients. Will markets crash? And what should I do about it? My answer is always the same. Yes, they definitely will crash. And absolutely nothing is what you should do about it. Now, I must pre-qualify that second statement by saying absolutely nothing as long as you've planned correctly in the first place. We have to remember that crashes and corrections are a natural part of investing, and they must be expected. The returns we've seen in recent times are not normal, but setting a long-term investment strategy means that we're focused on long-term trends, not short-term movements. What matters is working out how much you need to enjoy your life when you're relying on your capital, calculating how much risk-free cash to set aside, understanding how long your money will last and what return you need. All things that have been covered or will be covered in future videos. So if you haven't already, please subscribe to the channel. And while you're down there, drop a little like on the video if you don't mind. It really helps these messages reach more people. If you can create a visual roadmap of your financial future, where you plot in any bumps in the road you might encounter, like market crashes and higher inflation, it can allow you to be more objective and prevent you from making mistakes. This is exactly what good cash flow modelling software allows you to do, and I've included some details on that in the description below. But knowledge is power, and it's the key to good preparation. Just look at this table of returns from the S&P 500 index between 1928 and 2022. There are numerous years, and sometimes prolonged periods where markets fall. But notice some of the returns delivered in the years immediately afterwards. These bounces happen because investors start to realise that prices are now so low they can't ignore the value anymore. So they pile in while it's cheap, sending prices up. The stock market's not complicated. It's just a market. People buying and selling stuff. When you've got loads of people selling something, its price will go down. It has to make it attractive enough for someone to buy. If you've got loads of people buying something, its price will go up. The best thing you can do when investing is just close your eyes and ears and ignore the madness. I'll let you in on a little secret. I probably don't look at what stock markets are doing for weeks at a time because I don't care. I'm not interested in what's happening in the short term, only in the long term. But I know what some of you are probably saying right now. That's all well and good, Chris, but I'm retiring next year. I haven't got the long term before I need to start taking my money out. Well, that may be true, but do you need all of your money on day one? Is the money in your ISAs and pensions still going to remain invested throughout retirement? If so, you could still have a 30-year plus investment timeline, which means you're still a long-term investor. Okay, I get that, but I'm still nervous that my portfolio is so heavily allocated to the US, and particularly the big tech companies. Surely that's going to cause me a problem. Well, you may be right in the short term, and it's still sensible to diversify with other assets like bonds, gold and precious metals, property, perhaps even cryptocurrencies. But the problem doesn't lie in recognizing a risk. It lies in doing something about it that actually puts you in a better position, not a worse one. Like I said at the start, you don't just have to be right about one thing. You have to be right about 5 or maybe even 6 different things, and to execute them all perfectly without a crystal ball. Vanguard have published some good research into this, and they break these factors down, which I'll go through with you. The first is the signal. You need to be able to identify a reliable indicator of short-term future market returns. Now, arguably, this is the easiest thing to do. We can generally spot events that might have an impact on markets, but that alone isn't enough. because the next thing you've got to get right is the timing of exit. To be fully effective, you've got to get this right down to the precise day, and timing the very peak of something is nearly impossible, except for blind luck. Too early and you miss out on gains. Too late and you've already lost. The third factor is the tilt. What alternative asset are you buying in place of what you're selling? Again, you've got to be right that the asset will benefit from the other one falling. And there are many times when this doesn't quite play out in the way that you'd expect. If you do manage to get all those things right though, you're still not out of the woods, because you've then got to get the timing of re-entry spot on. There'll come a point, you see, when the prospects for the asset you've sold start to improve again. And this often comes without much warning. To be successful, you need to be out of the alternative and back into your original asset to capture this upside. Because if you're not, it will erode any gains you've made on the swap. Of course, to make any of this worthwhile, you've got to decide on another crucial factor: the size of the position. How much do you sell of what you own and then buy of something else? The bigger the bet you make, the better or worse it can work out for you. If you're right, a big bet can work wonders for your return. But if you're wrong, it can be disastrous. And finally, you've got to consider costs. Are there transaction costs? Are there tax implications? Could currency differences play a role? All these factors could have a serious impact on whether you win or lose. In some cases, they could even turn a winning position into a losing one. So as you can see, getting all of this right is like trying to play chess with a blindfold on against a grandmaster. But let's say you do decide to take the extra risk, and it does go to plan. Is the payoff even worth it? Well, in Vanguard's research, they showed back-tested data of what would have happened if you got these calls right or wrong over a 26-year period. And they found that even if you were right 75% of the time, your return would only have been slightly higher than just leaving the portfolio alone. That's 75% of the time. So it might interest you to know that other research shows even the best fund manager in the world will only get their decisions right about 55% of the time. Now, they have decades of experience, teams of analysts, and access to data that they're paying hundreds of thousands of dollars a year for. So do you think you can do better based on a hunch from what you read in the news? You may be very confident of something, but your mind can play tricks on you. It's like Mark Twain once said, "It's not what you don't know that gets you in trouble. It's what you know for sure that just ain't so." As a financial advisor, I always tell people that my job isn't to manage money. It's to manage your behaviour towards it. That's where value is added. There's a well-known story of some research Fidelity did into which of their account holders enjoyed the best returns. And they found out their most successful investors were the dead ones, or the ones who'd forgotten they had an account in the first place. In other words, people who didn't try to mess around with what they held. So having the input of someone with an emotional detachment from your money can be very valuable. Warren Buffett famously said, "Never bet against the US." And he could be wrong. But having a globally market-weighted index portfolio means that your capital will end up being allocated to where the money is, which is currently the US. If it rotates out of the US, though, your portfolio will end up reflecting that without you having to guess. As someone who's advised people for a long time, I can tell you that I've seen more money lost trying to anticipate a crash than has ever been lost in a crash itself. So yes, markets will crash, but as long as you have a robust strategy in place to begin with, I'd suggest just remembering the sage advice of Vanguard founder Jack Bogle, who once said, "Don't just do something, stand there." Now, if you're currently wondering how you should allocate your investments for taking an income, then I'd suggest that this video on screen now is where you should start. In it, I explain the main role of different assets in your portfolio to create an all-weather strategy in retirement. I'll see you there.